So how do you qualify to buy a house? Today we're going to take a look. Stay tuned for Prudent Money. Good afternoon and welcome to the Prudent Money Radio Show. I'm your host, Bob Brooks. Thank you so much for joining me today. You know I do appreciate it. So in this market, how do you qualify to get a loan? Mortgage consultant Mark Pfeiffer is here today with me to give us some tips. Hey, Mark, welcome to Prudent Money.
Thanks for having me, Mr. Bob, and it's good to be with you live today in studio.
Yes, we never get this opportunity to do this, so it's good to see you. And we're working with one mic, a little bit of a technical problems today. And we just recorded, I don't know, a couple minutes of the program. I looked up and I thought, I didn't turn on the record. So it's already starting out really good thing. So let's talk a little bit, about the year. The year was maybe not what people hoped for, to get some easing on interest rates. It is what it is. Just reflect a little bit on how this year turned out for you guys.
Yeah, the industry as a whole, it was relatively flat this year, similar to last year. Slightly better. We had a little dip in rates in September of this year, so that helps things a little bit. But overall, the demand, North Texas is no exception, but overall the demand is still relatively soft. Again, part of that's just affordability. Home prices still, to this day, continue to increase in many areas. There are some soft spots here in Texas. Austin's been one. North Texas has its pockets. But overall, I'd say it's a okay year. Wasn't a banner year. Wasn't a terrible year, but we're making it, and I do expect and hope for better things to come in 2026.
Yeah, it's gotten very, very complicated, that's for sure. But, one of the things that I started thinking about it, we're starting to see home prices come down, of course. At some point, there's a balance there that you hit where you saved enough on the house. It's okay that you're paying a little bit more on the interest. Is that a fair assessment?
It is, and it's interesting. You pick the pocket. There's still some neighborhoods, and they're small, and they're few and far between. But there are pockets where people are still really competitive, few different, multiple offers. But as a whole, especially the outskirts where there's a lot of new construction, we are seeing prices drop. Now, just to be very clear, we're not talking mortgage meltdown drop. We're not like a 20%, 30% drop. All right, we're talking to it is real money. So not to discount, 10 grand, 20 grand, but on a $600,000 house that was worth $400,000 3 years ago, losing 10 or 20 grand, while it's not ideal, it's still been a good thing and a great purchase for those folks.
This is Bob Brooks, and you are listening to the Prudent Money Radio Show. Thanks so much for joining me today. I do appreciate it. I'm here in the studio today with Mark Pfeiffer. We're talking about the real estate markets and how to get that mortgage sealed and get it done. So we wanted to do what we're calling the definitive guide to qualifying for a home. And I guess where we start with that, there's it's kind of levels of qualification. Qualification light, and a qualification done. So talk a little bit about that and where a person should be when they start out, what's ideal, and kind of through the process.
I love the light and done. I've not heard that, so I might start using that. But the reality is that it's true, right? There's the two most common terms are pre-qualified versus pre-approved. Pre-qualified is based on just information. You tell me you make $10 million a year, I'm going to believe you. I don't have any reason not to. Versus you show me documentation, that's what converts it to a pre-approval. So if you are thinking about selling your home, look for pre-approvals. It means there's been paperwork to validate information. So to use your terms, pre-qualified, that's light. Pre-approved, you've done the homework, and that's the part that shows that one, you're serious, and two, the skeletons are no longer in the closet if they're out there.
If you start out the process, you gather all the paperwork, you go through the applications, you submit everything, about from that point to the point that they can say confidently, yeah, we can pre-approve you, about how long does that take?
That's a good question and a loaded question. I'll answer honestly in that if you give somebody the paperwork, and it's all of the paperwork, and that's the qualifier, it's all the paperwork, you can reasonably expect an answer back within few business hours, call it 4 to 8 business hours, whether it's 1 to 2 days, but relatively quickly, assuming you're working with somebody that has that capacity. If you go to a bigger bank or somebody that's just more of a machine, it could take 2 or 3 days. And it also depends on the complexity. If you own 7 different companies, it's a lot of tax returns to look through. It could take a lot longer than, say, the guy that works at Lockheed Martin and gets a W-2, and it's super just straightforward. So to answer your question, you can typically get pre-approved within a few, call it 1 to 2 days of submitting all your documentation.
So talk a little bit about how long those pre-approvals last, because they obviously can't go into affinity.
No, that's a great question, and that's something to consider as well. So when you submit documentation, the mortgage world will actually have its own guidelines as far as how long stuff lasts. So whether it's 60, 90 days before it needs to be updated. The reality is, my answer is it's valid until something changes. Right, and more often than not, it's going to be until something changes from the client's perspective. So, in other words, if somebody, let's take that guy that's just normal W-2 self-employed or normal W-2 salary guy, 4 months from now, as long as the credit's been paid on time and all that stuff's done, the documentation will need to be updated. But in my mind, the approval is still valid. Versus the self-employed guy that now has taken on a whole bunch of business debt in the last 2 months or done things to expand and spent a lot of money. That may change it. So as long as the information is valid, I would say you're good. But I think the generic answer you're looking for from an industry, I would say about 60 days, 90 days until you probably need to get that documentation updated.
And I guess that would just that would mean getting it reviewed and to make sure everything was how it's supposed to be. Let's talk a little bit about the ratios, the dreaded ratio. It could be the dreaded ratios or for someone with a lot of debt. But talk about income versus debt payments. And I would assume there's a little bit of a difference of maybe another ratio that shows, well, it's not a debt payment, but it's an obligation.
So DTI stands for debt to income. That's the ratio. If somebody says, how much home can I afford? DTI, debt to income. The math is relatively simple. Take your monthly obligations, including the new mortgage payment or the potential mortgage payment, and anything that you pay debt obligations on each month that show up on a credit report. And maybe things that don't. Credit card payments, the minimum credit card payments, minimum car payment, student loans, things of that nature. Something that you owe in life. That's the debt. And then you take all that sum, that monthly obligation, and you divide it by the gross household income for them, or whoever's on the loan, I should say. The debt to income is the debt divided by the income. So let's take an example. If a household makes $10,000 a month, that makes it for easy math. They're going to spend $3,000 on a mortgage payment. They have 2 cars and no credit card debt. Let's say the cars total $1,000. Well, $3,000 for mortgage, $1,000 for the cars. That's $4,000 total. No other debts. Divide by the $10,000 each month gross, meaning pre-tax. That's a 40% DTI. In the mortgage world, that $4,000 divided by $10,000, they want to see typically, not always, but typically about 45% or less. So that may seem like a lot, but take up your monthly obligations and divide it by your income, and that's what they're looking for. And ideally, they don't want you spending more than about 45% of your gross income with all the debts.
So when will a bank make an exception on that? Because I'm sure that's what people are thinking.
Yep. So it depends on the loan program. For the generic Fannie Mae, Freddie Mac, kind of the plain vanilla stuff, the system, the computer will tell you. It'll take a whole comprehensive look on, how much money do you have in the bank? What kind of loan program are you doing? How much down payment? I would say that 45 is pretty good. You might see it sneak a little higher here and there. Other programs like VA, FHA, they're going to be far more lenient. But again, it goes back to the tell us the story. For example, a lot of times maybe you're doing it to where one of the spouses doesn't have good credit and they're not on the loan. Well, it's not used for approval, but it can be used as a compensating factor. So if we're using just one of a person's income, not the other, they might allow those debt ratios to go higher in an underwrite. So to answer your question, depends on the program. And there's no hard and fast to say, here's what it has to be. It's going to be on a case by case. And there are guidelines that prove it, but it's just not for the sake of a quick answer.
One thing, and I've gotten tons of education on how this works through the years and doing and having these talks with you. It would seem that the importance of having a mortgage consultant working for you is that it just always comes back and dawns on me. There's so many programs that you got to know, and it's not you got to know the details of those programs, and then you've got to be good enough and patient enough to find which program works for the individual trying to get the loan. And that is, I just want to say that because you probably won't. That's a tough process, or can be.
Oh, I'd say it's insurmountable. I will be the first to admit. So the company I'm at now, it's a very big company, and we have more products than I even know, Bob. Like on a regular basis, I'm like, we have that. And the truth be told, I don't sell the things that we don't know. So if somebody comes, our team knows what we know, and it covers 90% of what's out there, 95%. But there's certainly going to be that little niche that somebody comes and wants. I just learned we do Native American loans in Oklahoma, and there's little twists and turns on that. And that's just not something I've come across, but we do them. The reality is my team will be most likely will be to refer that out, because to your point, to know everything, I always, long ago, I thought AI, before AI was a thing, I thought we'd be replaced. I thought, man, you can %. I think that is going to be 20% of the market, making up to 20%. But I think there will be people where it's plain vanilla. You can do this. You know what you want. You're educated. But it's a financial instrument. It needs to be part of a financial plan. And there are so many twists and turns, and your rate can be so different from one to the other. To your point, it is go back to the industry and say, man, we're going to be here. Yes, AI might do something for us in terms of streamlined paperwork, but there's just too much to know to where one person can't honestly admit, yeah, I know everything, because I promise you I don't.
Let's talk a little bit about, of course, this is a big topic, student loans and student loan debt. Maybe you're trying to apply for a mortgage and that's deferred. It's not, they don't have to pay for it. The kid's not out of college. How is that handled?
Yeah, there's actually, I'll admit that I have a phenomenal team, and one person in particular, she's got personal experience, both as herself and her kids. So she's our resident expert. There's a lot of different ways. If anybody's had a student loan, you know there's a lot of different ways to structure and a lot of different things with the government rules, this, that, and the other. I would say this: if somebody has a student loan and you are contemplating buying a home anytime in the next 12 to 24 months, in the next year or two, get with a mortgage consultant. Have the conversation and figure out what it is, because there's a lot of ways that you can restructure, extend, defer. I would just make sure that you have a conversation about how does that impact the home, because there's too many examples that say, oh, here's how to do it on a radio show. It's going to be based on you and what your agreements are and what you're paying or not paying and the deferment. But it is absolutely prudent, to your point, Bob, if you have student loans and you want to buy a home in the near future means 1 or 2 years, start the conversation today. There's no downfall to having that conversation too soon.
This is Bob Brooks, and you are listening to the Prudent Money Radio Show. If you want more information about Mark, go to mortgagemark.com, and he's got a lot of great educational type information on that website. Go check it out. That's mortgagemark.com. Let's talk a little bit about assets, from retirement to savings. What's the underwriter looking for? Do they put a lot of emphasis on that or not? I mean, kind of break that down.
So let's take that to two pieces. One is the just generic assets, liquid assets, and the other would be retirement accounts. For liquid assets, we care more about those because they are, in fact, liquid, things you can access today. You don't need permission or to go through paperwork to get them. And so you'll get credit for the money there. Large deposits will be something they look for. People are like, well, I don't want you to see how many times they eat at Taco Bell. We don't care. Right? I don't care that you got Disney and Netflix and all those subscriptions. What we do care is if $20,000 just shows up tomorrow that's unexplained. So those things are part of the Patriot Act to make sure that people aren't selling drugs and guns to buy houses. On a retirement account, if you're not of retirement age, you're going to get knocked down. Different programs are different, but it could be 60 to 70% of the value. So if somebody has $100,000 in a 401k, from a qualifying standpoint, we'll give them about a $70,000 quote unquote assets in the bank. It's not, but again, you got to figure tax withdrawals, all the stuff that goes with it. And I would say this, you didn't ask this question, but if you are considering taking money from a retirement account to purchase a home, I highly recommend exploring borrowing, not withdrawing, borrowing the funds from yourself as opposed to withdrawing if you're not of retirement age. I'll let someone like you who's on the financial side have that conversation, but that would be my first just by default if you are considering using those funds. There's good reasons to do both, but I think that's where, get with someone like yourself, Bob, that you guys can get financial advice of what to do and make sure that impacts your tax strategy and your financial future.
Let's talk a little bit about credit scores, and I came across this information about how they're changing the formula up. And it seems to me that what they're not saying and what they're doing are two different things going on right in front of us. Is that it looks to me, you explain it, you tell me if you agree. It looks to me like they're trying to make this easier for people to get into homes. Is that what, or is it because they really have? It's interesting what they've done with the models and everything.
Yeah, I think some part is, they're trying to figure out. I mean, ultimately, what I think it amounts to is they would probably say the politically correct answer is they're trying to determine an accurate credit worthiness, and they're trying to goof with the models to do this, that, and the other. I will say this: I've been doing this for over 20 years, and there's been talks about just big reform almost every year. Something's coming; they're changing this. Until it's here, you can speculate. But the mortgage world, from an interest rate from a credit standpoint, hasn't had a whole lot of changes in recent time. I know credit reports have gotten way expensive, outpaced inflation as far as what they cost and what they do for them. It is a money-making business. So if they tell me they're doing something for the betterment of the consumer, I'll be honest. Some of that's I'm like, well, what dollar amounts coming to you guys, and what's the business angle on this side? Because at the end of the day, if it's not broke, don't fix it.
What's funny is I would normally catch that. Now that you said that, I go, oh yeah, that's right. What's going to benefit them?
It's those agencies are for-profit companies. Experian, Equifax, TransUnion, they are for-profit. When you get your credit pulled, if you're not on the opt-out pre-screen, just Google opt-out pre-screen. There's a website where you can do it. Think of it like the do not call list. Because if you're not on it, and a mortgage company or any other credit company pulls your credit, the credit bureaus will sell your information. They're called trigger leads. They will sell your information to other people in that industry or other people that are adjacent to try to blow your phone up and get you to do something financially. So they're in it for business. They're in it for money. So anytime there's changes and talks of reform, I always just question, what's the real motive behind this? Because at the end of the day, it's not a bad system. It's not perfect, but it's good. So I don't know that we need a huge overhaul.
Well, I would say look at it post and pre 2008. That it's drastic. Yeah, it went through a lot of changes. I'm assuming.
And even then, in the 2008, it was more just the standards. It wasn't so much the credit reports changed. It was just the standards of underwriting, which is a mortgage decision, a mortgage industry decision. But all the credit reform talk and this, that, and the other, that's a lot of it's coming from the credit bureaus. And again, what's their angle? Because at the end of the day, the credit standards, that as long as we know what we're looking at, we can make our decision of how aggressive or not to get, right? Aggressive or conservative. The credit bureaus, when they're going to goof with something, I just don't know where the real benefit is.
Okay, let's talk a little bit about credit scores. What is the underwriter looking for? You've always said, Bob, there's the credit score and then there's our credit score. And they're two different things. Talk a little bit about that.
You're a good student, Bob. You're 100%. That's exactly what I was about to say. Is mortgage credit scores are different than consumer credit scores. They're different than automobile credit scores. So somebody that pays for a credit reporting monitoring company, your scores will tell you a number, and it's not that it's wrong. It's just our grading scale doesn't go as high. We just use a different model in the mortgage industry than what consumer scores do. So in general, I would say that generally speaking, mortgage credit scores come in 50 to 75 points lower than what somebody might see. So if you get your credit card company says you got a score of 800, I might expect to see something around a 730, 740. So that's number one. Number two is your question was, what do mortgage companies have? Different programs are going to have different standards. Typically, I tell folks if you got a 7 in front of it, you're an A student. 650 to 700, you're probably somewhere in that C to B range. Under 580 to 640 is kind of that to be determined based on the program you're doing. We can absolutely do programs at 580. You just may not be able to buy that $3 million house with 10% down with that kind of credit score. So it does vary based on the program you're doing.
So how many programs do you think are out there?
Oh, I honestly couldn't even. I mean, hundreds. I bet if you took out each one, I would say hundreds, 100, 200, kind of overarching, and then certainly underneath each one of those, one institution might have different tweaks to it than another one. But it's more on a page that I don't. And again, you click on one little link that is this program, you're looking at 100, 200 pages of guidelines that you have to comply with, and certainly there's going to be some overlap, but there's a ton. It really is.
Okay, you've already mentioned it, and you talked about how much somebody puts down. Talk a little bit about PMI, what it is, and kind of what the guidelines are.
Yeah, so let's use the term MI, mortgage insurance, because depending on the program, it can be called PMI, MIP, upfront MIP. All those different words mean the same thing, which is just insurance that you as the homeowner are paying on behalf of the mortgage company. So when somebody doesn't put down enough, when they do a certain program, or maybe they don't put it down enough money, the mortgage insurance is there to protect the lender. And you can say, well, that stinks. Well, they're making you a loan with some extra risk. And so it's just insurance. So to answer the question, I think MI, mortgage insurance, whatever you want to call it, it's a good thing. I think homeowner, it wouldn't be good if every citizen had to come up with a 20%, 30% down payment. It would absolutely stifle the purchase activity, and it would be tough to even buy a home. So mortgage insurance is good. It's not bad. Sometimes it's tax deductible. Depends on who you are and how much you make, and really just how much you make. But it's a good thing, and I think it's a wonderful. It gets a bad rap sometimes. I think it's a wonderful option.
So talk a little bit about maybe the interest in adjustable rate mortgages, because I would assume that's become kind of a little bit of a hot topic.
Yeah, they're on the rise. For those that don't know, an ARM, adjustable rate mortgage, is something that has a fixed period and then ultimately will change based on where rates are in the future. In an environment like this where the Fed has started decreasing rates, ARMs are going to become more and more popular. So they are picking up steam. Haven't seen enough to where it's become a commonplace, but it's definitely at least now on the radar where they've been MIA for the last 3 to 5 years.
So if you're using an ARM, you're doing it to lower the premium, the mortgage payment, excuse me. So in a sense, doesn't an underwriter look at that from a negative standpoint?
It's a good question. So with ARMs, you have to you look at what they call the qualifying rate. So even though you might get, let's say the ARM rate's a 6%, making that up. Let's say it's 5%, just for grins. If the ARM rate's 5%, but the qualifying rate could be 7%, because they want to say if this thing goes up in the future, you can qualify on that higher payment. So it does vary based on the ARM and a whole bunch of other terms, but ultimately they do qualify you on typically higher rates, so that if it does go up, you can't say, hold on, I got a loan I couldn't afford. So they do qualify you on the higher rate.
So you've got to obviously have programs that, in fact, we talked about this at some point, but you were talking about programs where you didn't even have to put anything down. That's got to be a brutal payment.
No, it can be, right? It's all relative. If you don't have the money, you don't have the money. But I think owning's typically better than renting. Not always, but I think that's the majority of the case. I would agree with. But zero down programs, they exist. And if somebody says, man, I'm upside down, it's probably because they put zero down. And yeah, that 10 to 20 grand we talked about at the opening, if your house is down 10 or 20 grand in value in this market, you might be upside down for that moment. Not by a lot, but enough to notice if you put zero down.
So what happens in a situation where you've done everything right, you've gone through the procedures, you got pre-approval, done everything you're supposed to do, you put a contract on a house, and it's really interesting. I'm hearing more and more stories about, oh yeah, that house is under contract, now it's fallen out of a contract and it's back on the market. What's going on there in some of these situations?
Yeah, I saw a stat, and I don't know if I'm going to get it exactly right, but about 17%, so whatever that is, 1 in 7 houses now, their contracts are getting canceled. It's a big deal with new construction. I don't know if it's cold feet. I don't know if it's job loss. I don't know if it's they found a better house. Certainly higher than normal, but I'd say in a normal market, I think the normal is 12 to 14%, and now we're at 16 to 17. Doesn't sound like a lot, but it is when the inventory, what's being sold, isn't enough to begin with. It's a smaller scale to guide, so it's a bigger number.
Well, Mark, listen, I appreciate you. I appreciate friendship over many, many years. I don't even know how long it's been. But I know that you take real good care of people. MortgageMark.com is the website to get more information. And listen, Merry Christmas to you and your family. I know that's always a big deal. You got kiddos to get excited when Santa Claus. I'm just lucky if I get my kids out of bed. So no waiting up for Santa Claus there. But Merry Christmas to you.
Merry Christmas, Bob. Thanks for having me as always.
This is Bob Brooks. You got a question for me, please go to the website at prudentmoney.com and send it in, because we are all out of time. Till we do meet again next time, keep the faith and have a great rest of the day.
That's all the time we have for today. Questions or comments for Bob, or to find out more great information like what you've just heard, visit www.prudentmoney.com. Be sure to join Bob Brooks again for the next edition of Prudent Money.